The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everybody. This is Ken Kavula from the Mid-Michigan chapter, and this is the fourth class in our Successful Investing 3 series, subtitled The COVID Cancellation Conference. This will be Cy Lynch's turn to speak with you. The title of his class is Stacking the Deck in Your Favor, and he's going to be talking about different ways that you can maybe tilt the odds just a little bit on your stock selection guide to have a better chance of making a little bit more cash for your nest egg. I'm joined here with Cy and with my good friend Mark Robertson, and we'll be in the back room trying to answer questions as you have them. We do have a sizable registration today, so we're not going to be able to answer all of the questions that might come up. And we do have a hard stop on this class at 10 minutes to 3 because our panel discussion begins at 3 o'clock Eastern time. We'd love for you to join us, and if you're not registered for that, you can still register for that panel discussion. If you go to manifestinvesting.com/events, that's a non-subscription part of the website where you can find a link to register for the COVID cancellation culminating event, and it's a panel discussion with 8 pretty astute investors from throughout the country. This is the name of this particular class is Stacking the Deck in Your Favor. The instructor for the class will be Cy Lynch. Cy is a lawyer, a minister, a financier, and he has all kinds of other experiences in his lengthy record as a service to different groups and people. Right now, he's a minister of a church in Atlanta, Georgia, and he's been a Better Investing member for years and years and years. Presently, he's serving on the National NAIC Board of Directors, which oversees Better Investing. We're going to get the legal stuff out of the way real quickly. Cy, if you could go to the disclaimer, everything we do today, and we will talk about real stocks in real time, we're making no recommendation. Everything we're doing is for educational purposes only. So we're not going to tell you to buy, sell, or hold any particular stock. We do recommend that you do your own analysis and you make your own decisions. We're here to help you make better decisions when it comes to looking at buying, selling, and holding stocks. We are recording this particular class and we'll have it posted on YouTube within the next 24 hours or so. We'll try to remember if we own any of these stocks to let you know that that's going on. And all of the views that are expressed belong to the commentators that express them. We're not representing any organization or any point of view other than our own. If you'd like reminders to come to Mid-Michigan events, they're all free. You can send an email to nkavula1@comcast.net. That's my wife's email number. She'll be glad to add you to our guest list from folks throughout the country. And then once a month, we'll remind you about the free programs that we run for our chapter and invite you to be a part of our educational program. If you'd like copies of the slides, you can write a note to Mark R. at manifestinvesting.com. And Mark will see that you get complete copies of the slides themselves. Cy, if we could go on to the next slide.
Okay. Well, I think we went one too far. There we go.
Thank you. Okay. This class is the 4th class in the series. We will follow it at 3 o'clock Eastern time with our 5th and final class. It's a panel discussion. Let's talk stock panel discussion. So we hope to see a lot of you there. We have 8 stock pickers from the East, the West, the North, and the South. And we have some pretty savvy people among our group of stock pickers. So we hope to see you at our next class. And meanwhile, let's give the floor to Cy Lynch. Cy, we really appreciate you doing this for our community, and we know that the class will be worth our time. Take it away, Cy.
All right. Thank you, Ken, and welcome everybody. Thank you for spending your Friday afternoon with us. And for those who will either as a repeat be seeing the recordings or on your own time, I welcome you folks as well. What we're going to be doing for about the next 45 minutes, maybe hopefully a few minutes less, is taking a look at stacking the deck in your favor, and just to get everybody on kind of the same sheet of music, to change the metaphor. What is stacking the deck? Of course, in cards, it's increasing your chance of winning the hand. Applying it to investing, it's increasing the chance of meeting your investment goals. Or really, the way I like to look at it is to go ahead and state it in the negative, reducing your risk. And I think that it will flow through this class, making clear Warren Buffett's definition of risk. It comes from not knowing what you're doing. So really what we're going to be spending some time doing is looking at some ways that we can use our Better Investing NAIC tools in a more efficient and a better informed way. Unlike my Getting Risk Right class, or classes of those ilks, we're not really going to get discussing that much about what risk in a financial sense is outside of Warren Buffett's definition. The other thing that I want to kind of set as a foundation before we jump in is looking at the Better Investing principles. Invest regularly, regardless of the market outlook, and specifically Better Investing Principle 3, to invest in or to buy growth stocks when they're selling at good value. We don't need to go into it at great length, but realize that alone stacks the deck. We know that over the long term, stock prices follow stock earnings. Stock earnings, or earnings per share, over the long term follow sales. Sales is actual growth. So if we're buying stocks growing faster than the economy as a whole, which is my loose definition of what a growth stock is, and you buy it at a good value, then you are going to do better than stocks that grow slower, or stocks bought at poor values. So today we're going to try and increase our confidence, first of all, in our quality conclusions, buying quality stocks, but also in our value conclusion. That's the buying them at good value. And we have a two-sided focus. And I thought I caught this nomenclature a little earlier, but I must have caught it in another slide, or I spaced out when I did it. You can tell I've been doing this a while. I am using language from the old paper days that really fits even the desktop software, Toolkit and the like, well, as far as side 1 and side 2, but really and truly for there. Yes, I see how I did modify it. The SSG graph is really what I'm talking about if you're an online tools user. And then section 2, what many of us, like me, call side 1 of the stock selection guide. There we see consistently good management. We're looking for good growth, good profitability, and also we want financially strong companies. We'll talk a little bit about more about that financial strength during the class today, because really the stock selection guide itself doesn't tell us a whole lot about the financial status of the company outside, again, of the consistent financial management. And we'll also look at comparing quality so that we find the best of the best to invest in. When it comes to value, again, we're looking at using the two-sided focus, page 2 of the stock selection guide, or really the lower part of what would be page 2 in sections 3 through 5. That's the valuation section. We're going to talk today a little bit about how you can increase your confidence in the company's historical earnings. That we're going to call quality of earnings. How sustainable are management's reported earnings. We'll talk a bit about how to use the PE, in my opinion, properly. PE is a vital part of our investing methodology, but I think there are better ways to use it and not as great ways to do it. And then we'll spend a little bit of time at the end talking about a potential alternative to our traditional return target that may be a little bit better. Give you something to think about as we close out the session. So in our graphic, again, the metaphorical page 1, we're looking for consistency and growth. Picture's worth 1,000 words. You like the company on the left versus the company on the right. And not only is the company on the right inconsistent in their sales growth, notice the profitability lines in earnings and pre-tax profit, and they go negative occasionally. In fact, there's even a warning on the SSG Plus that they're currently negative. So how can we increase our confidence in our quality determination, our consistency determination? When the changes are as graphic as they were in the last slide, it's pretty easy to see which is better. But sometimes we can be more confident in our projections and in our evaluation of history if we quantify some of the quality determinations. One way to do that with growth is something called the R-squared. It's just a statistical or a mathematical measure of how straight the sales and earnings lines earnings lines are. They're super for making comparisons. Again, back to that, finding the best of the best. You might find some rule of thumbs either for R-squared or for earning stability, which we'll be talking about from some other sources, value line included. But beware of hard rules. It's really a comparison more so than something that you want to set absolute minimums. And I'll just throw one thing out. If you have a company that is drastically increasing its growth rate, either growth in sales or increase in earnings per share, that can distort the R-squared or the earning stability lines, result in a low score, yet we're all looking for that blowout company. So actually, that's another reason why you want to be wary of hard rules. Here's just an example of where you can find R-squared on Toolkit 6. It's on the first page of the form. At the bottom of the graph, you can see down there with the historical information is the sales growth R-squared and the earnings growth R-squared. The online tools do not have it. This is just kind of a bigger view of that on your stock selection guide in the Toolkit program. Online tools do not have it in the graphics. However, you can find the R-squared in the comparison guide. So again, when you're making comparisons between companies, you can see the R-squared there in the growth comparisons area of the online stock selection or stock comparison guide. I've alluded to a moment ago, Value Line has a similar measure that they call earnings predictability. And this particular company, Paychex, at the time this slide was prepared, had 100, the highest Value Line score. You notice the R-squared was also high, though it didn't quite hit 100. Value Line uses both a statistical measure, and a few other factors to come up with their earnings predictability. Morningstar has a growth grade, and I believe they still have that growth grade. I actually noticed in updating my slides for this class that Morningstar has done away with their financial grade, but I believe they do still have the growth grade. But notice that the growth grade is both a quantitative, as well as a let's get this right, quantitative as well as a qualitative measure. They take both the amount of growth as well as the consistency in making that grade. And then you can also find a quality ranking, which includes a number of factors, not just growth all by itself, on what we used to call the S&P reports, now the CFRA reports, and it's the quality ranking there on the first page of the report that both, again, does include the rate with consistency, and it also includes dividend growth and consistency along with earnings per share. I did not include a slide here, but we will look at manifest investing briefly as well, and they do also have, similar to the value line, EPS predictability. It's an earnings stability rating that, again, is similar to the R-squared, that includes historical and even some projected earnings into the future. That allows you, again, to quantify this idea of consistency of growth. So let's move then to the next stage. We can compare consistency. Of course, to find the best of the best, we want to compare absolute growth rates. How well has a company done versus its peers and or competitors? Frequently, they are the same, although there are times that a company might really be a peer but not a competitor because they serve different niches in a market. But largely, peers, competitors are pretty much synonymous. Using the online tools, you can, in the SSG Plus tool itself, you can compare the tools, and here's the screen that pops up, and you're able to compare against named competitors, the peer group, as well as the industry. Again, the stock comparison guide gives you the ability, as we've already seen, to compare earnings stability, as well as to compare industry averages and to compare specific companies, the growth rates historically, as well as your projected growth rates if you've completed the stock selection guide, which in this particular slide, I had not done that yet. We also want to look for consistency and profitability. The primary profitability measures that we use in the NAIC Better Investing Tools look at are pre-tax profit on sales. That's probably the biggie, the 75% or so, but we also look at return on equity, which is the return on shareholders' investment, at least, again, figurative investment in a company, the book value in a company. And again, looking at the two companies we used for growth consistency earlier on, Paychex and Transocean, you see that Paychex is relatively consistent. Transocean is all over the place. So that you're looking at the consistency. One reason that I like this slide for teaching purposes, and I'm not going to spend a lot of time on it, but I want to mention it briefly, is be careful when you use any tool, be it the Investor's Toolkit, be it online tools with Better Investing, and perhaps other tools as well, when they purport to give you, let's say, a trend analysis. And notice that, interestingly enough, you get a green trend analysis with Transocean and a red trend analysis for pre-tax profit for Paychex. Yet I would say that's actually the reverse. Paychex is far better, and understand the reason for that is Transocean pre-tax profit, they're losing money, but they're losing less than they did over the last 5 years on average. Therefore, the trend shows green. Paychex, on the other hand, has earned just a little bit less pre-tax profit on sales, or pre-tax profit as a percentage of sales, than the 5-year average. Therefore, the trend is down. But the other reason that I'd caution you against just looking at absolutes is notice the very high level of profitability in the mid to high 30s, and 2 percentage points or 200 basis points, if you talk that language, when you're in the upper 30s is not a whole lot. That's less than 10% year-to-year move, and companies vary a little bit. On the other hand, if this were a retailer with very low profit margins, like 5%, 4% or so, depending on the retailer, where you could be at that level or lower, a 2% move is huge. In this particular case, you're just seeing a little bit of normal variance. Then again, you can do profitability comparisons, just as you did growth comparisons on the SSG Plus comparison tool, or compare to peers tool. And you can also compare to industry averages. And then you can also make the same comparisons, both industry average as well as company by company or peer comparisons, on the stock comparison guide tool. And these are all, I'm using the online tools for most of these slides in the comparison area. The comparison guide tool is also in Toolkit 6 for those of you who have Toolkit 6. The peer comparisons graphics, such as you're seeing here in the SSG Plus tool itself, that is an online tools feature of SSG Plus. It is not in the toolkit form. So let's move on from consistent growth and consistent profitability, comparing that to find the best of the best, sticking, however, with our quality thoughts, buying good quality growth companies from investing principle number 3, to look at financial strength. Companies have debt. So where does debt fit in to this quality determination, this financial strength determination? Our stock selection guide includes one measure of debt percentage to total capital. How much is a company's debt compared to its total capitalization? Debt plus shareholders' equity. In isolation, it means nothing. That might be a slight overstatement, because there are debt levels that could be dangers for certain industries or certain businesses. But even then, it's really most important in the form of comparison. Just to give you a couple of examples of why I say it means nothing in isolation, if you take a look at debt for a bank, you're almost always going to see debt over 50%, and you're going to see a very high debt level. You may say, my goodness, that's alarming, but banks make money on their debt. In fact, their primary lending capability is based on debt. For a bank, what you and I call debt, that being loans, our mortgage, our car loans, our personal loans, our credit card debt, those are actually assets for banks. What we see as assets, checking accounts, savings accounts, certificates of deposit, that for a bank is dead, and that's what they turn around and lend back to us or to other people. So you're going to see banks, and banks aren't alone. There are other capital intensive businesses that have very high debt levels. On the other hand, you see, let's say, a software company with a 10% debt. That's probably astronomical for a company that has virtually no fixed assets. So that's why I say it means nothing in isolation, but it's extremely important for comparison between a specific company and its industry, or between companies in the same industry. Again, looking for the best of the best. The one last thing, though, that I will say before we move on is don't necessarily consider as an absolute rule all debt being bad. Debt is a valid way companies can capitalize themselves. And in fact, depending on the industry and the specific business models, you may actually find, as long as a debt level is manageable by the company, the interest rates and the payments are easily made given the company's cash flow and profitability, you might prefer one company that has a higher debt level, because companies with higher debt levels will tend, other things being equal, to have higher returns on equity, which, remember, that's one of our profitability measures. So debt isn't always bad. These debt comparisons, especially important as the bull market is aging, perhaps where we are now, but it's not as helpful once the bear runs rampant. And the reason it's not is that once the bear market stops, once the flight to quality has already taken place, where the market as a whole is moving into high quality companies, fearing recession, fearing concern over high debt levels, it's really too late to bolster the financial quality of your portfolio. So you want to do that ahead of the market drop. Here are some ways to compare debt using our better investing tools. We're really looking at just this one measure, debt to capital. You, again, can see that on the stock comparison guide. Really more helpful than the just the debt ratio that we look at on our better investing tools are various data sources that include ratings of financial strength. And I'll apologize, I didn't catch it on this slide. I pulled the slide later on. Morningstar no longer gives a financial health grade. So just either in your mind, scratch that off, or take it off if you when you have a paper thing. Value Line, however, still gives the company's financial strength, and we'll look, I think, at another one as well. Here's where Value Line does it, down in the lower right hand side, and they give financial grades. An A is above average. Actually, a B++ would be above average for Value Line, and it goes as high as a ++. Manifest Investing, which is a subscription site. Actually, both Morningstar data that I've talked about and Value Line are also paid subscription sites. Many of us have access to Morningstar premium reports and Value Line reports through our public libraries, through a school library, or perhaps through a broker. Manifest, I don't believe, is available through any library or broker, but it too is a subscription site, and it has, I've mentioned the earning stability rating earlier, that measures the straightness of a line that you could see down at the bottom. It also has the financial strength, as well as evaluating a company's growth rate relative to its industry and its profitability relative to its industry. Each of those areas there are two ways of evaluating the financial strength, earning stability, and then the overall quality. First of all, the financial strength is given a numerical grade compared against all other companies in the manifest database, leading to a percentile ranking. This particular company, Paychex, is better than 94% of all companies in the manifest database. It's in the top 95 and above category. Earning stability, it's in the top of the top. Then you take these, they are turned into a grade that can go as high as 25, which then gives you a quality rating, which again, we're not going to get into today, but I just wanted to mention the slide briefly, that then is also ranked against all other companies in the manifest database to give you a quality rating, considering everything we've talked about so far. Consistent growth of sales and earnings, financial strength, as well as comparing sales growth and profitability to industry peers. I mentioned in the introduction when we started that we talk about testing the quality of earnings. Essentially, what that is doing is making sure that the company's reported earnings per share, which includes some accounting measures, some non-cash items that are perfectly legitimate. In fact, that's why we have accounting standards trying to accurately report a financial condition of a company that may or may not be the same as its actual cash position. For example, let's imagine a company that sells subscriptions. Maybe one of these financial subscription companies, a magazine or a book subscription company, insurance does similar things. There's any number of companies that are selling subscriptions for a service to be provided in the future. And I sell you a 10-year subscription to Cy's Best Investments, and I charge you $10 million for that subscription, and you pay that to me. Well, if we only looked at the cash value, I just put $10 million in my bank account. But the reality is I don't earn all of that money immediately. I earn it over a period of time. That's just a very overly simplistic way of looking at revenues. Expenses work the same way. And so accounting standards try and pair earnings and expenses. And sometimes this is not the same as cash flows. However, earnings that are all based on non-cash items, changes in non-cash items, may not be sustainable. So the way that we check the quality of earnings is to compare operating cash flow to net income. And ideally, operating cash flow should equal or exceed net income. Now, again, realize that even good companies may have a year or so that that's not the case. So don't treat it as a bad sign in every case, but it should be a red flag to investigate further. And again, if you see a company that is consistently reporting net earnings greater than its operating cash flow for year after year over a period of time, then you need to question how sustainable is that. Here's one place you can do it. There are multiple sources. Finance Yahoo shows you the cash flows that can show you a comparison along these lines. There are other sources. This is the Morningstar report that is linked from BI's online tools. I mentioned how you link there because this is a benefit of using the online tools, it gives you a bit more data than you would get on Morningstar's free site if you just go directly yourself. The premium site does contain actually even a little bit more data than this chart contains. But graphically, what you want to do is the bottom line on this chart, which is net cash provided by operations, or what I called operating cash, you want to see that as greater than net income or the earnings of a company. And for paychecks, you see over the last 5 years shown here, that was the case in every year. So to include the trailing 12 months. So from at least a cash standpoint, you can be confident that paycheck has high quality earnings. Their earnings are supported by actual cash. So now let's shift our focus from the quality focus, from increasing our confidence in our quality determinations, to choosing the best valued company. On the stock selection guide in our stock selection tools, we have a number of value metrics. We have total return. Largely, we talk about, can a stock double in 5 years? We have the PE ratio comparisons, most frequently comparing our current or our projected PE ratio to the historical PE ratio for the last 5 years. We also have a price zone. Is it in the consider buying, the consider selling, or the consider holding zones? And then we had the upside downside ratio. Those are our 4 basic options for determining the value of a stock at any given time. I contend that the best value metric is total return. And I get there by process of elimination. First of all, for those of you who have been around forever, know that upside downside ratios have been over history calculated slightly different ways. But if you are calculating it the way that all tools calculate it now, and I think everybody calculates it now, which is 25, 50, 25. If you don't know what I'm talking about, don't worry about it. It means you're young to the world, or at least young to better investing. But as I say, everybody calculates it that way now. But since we made that change 25 or so years ago, and it's become universal, price zones are redundant. If you look at a 3-to-1 upside downside ratio, a stock will always be in the price zone. It's just 2 different mathematical ways of looking at the same exact data. I would contend, however, that the upside downside ratio, and by extension price zones, are fatally flawed as a matter of logic. I do a whole class, or a whole chunk of a class, in making that argument. I'll give you the short version today, but there are 2 main reasons. I tried really hard to figure out how to make the low price calculation perfect in my early years with better investing, so that then my zones and my upside downside ratio would be as close to perfect as Cy Lynch can make it. What I ultimately concluded is it's impossible to rationally quantify market irrationality. When the market goes bonkers, you can't rationally project that. Interestingly, I could probably even add now, based on the last year and 2 or 3 months, you can't rationally anticipate all potential eventualities, because we all know what happened to the stock market and to companies in March of 2020 and the next few months, and is still impacting some companies, called the pandemic. And the market reaction to some of that was certainly overreaction, not able to rationally quantify market irrationality. But much of what the market did, at least at first, may have been an entirely rational reaction but again, to an event I don't think any of us anticipated. The more supportable mathematically and logically argument against the use of the upside downside ratio is it doesn't take into account dividend payments. So if you have a stock paying a significant dividend, the upside downside ratio, and again, for that matter, price zones as well, are going to be distorted. Comparing current PE to historical average PEs, I think while it is a measure of value, PEs are a measure of value. Don't hear me wrong on that. I'm contending the upside downside ratio has fatal flaws. The PE ratio on the other side is a valid measure of value, but I think it really fits better as a risk confidence factor. If I am projecting PE ratios for my company I'm studying to rise, to increase from the current PE ratio to increase in the future to usually historical levels for the company, then that should give me more confidence that I'm going to attain my return. On the other hand, if I have a company that's selling at a very high current PE relative to history, and I am projecting that PE to fall, I may still be able to get enough total return to meet my goal. I may still be able to double my money in 5 years, even if the PE ratio comes down, but there's a greater risk. The PE ratio may come down more than I am projecting, and it especially may happen very suddenly and quickly as, let's say, a bubble bursts in the market, either a market-wide bubble or a overly optimistic evaluation of the company by the market. So that's why I say the PE ratio is really, rather than applying it as an absolute metric, apply it as a confidence or a risk measurement. So as we start to wrap things up, what is the best value metric? I believe it's projected total return. Show me the money. It's the bottom line, and really it helps answer the most important question all of us have as investors is, can I meet my investment goals or not? Total return is the only of these 4 options that answers that question. And also we limit our downside potential, the potential of losing money through capital loss, by sticking with, again, high quality companies that we spent the first 20 to 25 minutes of the class talking about how to do it, by increasing our confidence in our value determinations and by comparing our value metrics to other companies so that we're buying the best of the best so that we can make reasonable projections about our value. Then taking that one step further, if total return is the best value metric, is there a better value metric? And this is the one that I'm going to leave you with today to ponder and think about. All of our tools allow you to calculate total return in 2 different ways. The first way, the way we've done it historically, and it's the first listed way on any of the SSG tools, is calculating it based on the high forecast PE. It's high PE times your high earnings per share, that being the earnings per share 5 years from now, to give you a potential high price. An alternative way of doing it is to calculate it based on an average PE. That is the forecast average of your the average of your forecast high PE and your forecast low PE, both of those coming from section 3 of the stock selection guide. Main importance of these metrics is that I stress is be consistent. Don't compare an average PE calculated total return for one company to one based on the high PE. There you're going to be comparing apples to oranges. So be consistent. And this is the biggest danger in section 4, is that there is a tendency on some people's part, and sometimes it's the fault of instructors putting out rules of thumb. That's instructors just like Cy Lynch that you're hearing today, putting out rules of thumb, in particularly rules of thumb relating to something called the upside downside ratio, that cause you to, what I call here, monkey with your forecast low PE. All of our stock tools allow you to set the low price wherever you feel is reasonable. So if you're getting what you consider, I'll use the strong language, wrong low price, or you find that a low price is not reasonable, don't adjust your low price by changing what you found to be a valid projected low PE. Just stick the low price that you find reasonable in. The reason being, if you change the low PE forecast, let's say that you found based on history the company's rational potential low PE over the next 5 years is 10, but that gives you a low price projection that is greater than you really want, just plug in the lower number. If you change that 10 to, let's say, a 5 to get the low price you're shooting for, you've now changed your average PE, which makes this average PE based total return invalid or less valid than it otherwise would be. And the reason why all this matters, it gives you a comfort margin. It gives you, many of our estimates are made in ranges. This again just brings this range idea into the total return area. And perhaps we can come up with a better target rather than seeking a 15% return, that's a fixed return, doubling your money in 5 years. Maybe we can use a variable return. I do that and model that in my semi-monthly, every other month, growth stock investment outlook article in Better Investing Magazine. You could see it. But here, and I'll close this out because we're out of time, but the handouts show you the detailed calculation. But essentially, it comes from value line, and you use the value line appreciation potential and convert it into a 5-year growth rate. Here at the market low from value line, just an average company, what you could roughly anticipate to get by throwing darts at a value line page would be 30%. 15% doesn't stack up very well. Similarly, at a market high, which is where we're bumping around right now, it's tough to find 15%. So you may cheat a little on your quality standards or on your projections. So it's better to come up with a variable return of beating the market by 5 percentage points, which is really what the 15% was intended to do. Markets return, let's say, somewhere in the 9 to 11% historically. So if you do 5 percentage points better, that's going to put you around the 15%. Here's the formula on how you do it. You can do it either on a spreadsheet or a financial calculator, or Google CAGR, that's for compound annual growth rate, CAGR calculator, and use the one that pops up. Or you can also subscribe to Manifest Investing that we mentioned earlier, and they have MyPAR, Manifest Investing Projected Annual Return, which is based on all stocks in the Manifest database at a given point in time. What is the median? What is the middle companies in the database? What are they expected to return? That's the same thing that Value Line is calculating based on their companies. The one difference between MyPAR on Manifest and Value Line's total return is MyPAR includes dividends, Value Line is only price appreciation. So here are the deck stackers. There are some guides to your judgment based on my 30+ years of doing stock selection guides. Not everything is going to fit all of you. So I encourage you take what's useful and leave the rest. You certainly don't need to apply all of these to be successful and important. They're also not all equally important. I kind of walked us through Investing Principle 3 and the stock selection guide itself. So I kind of took them what you might call chronologically or in logical order, but it's not necessarily priority. And I wish you many happy returns.
Well, Cy, we'd like to thank you very much for that presentation. If you have any comments, folks, this is Cy's email address, and he is a busy man, but I'm sure that if you write him a question and be patient, he'd be glad to interact with you. We do have our next class coming up in 10 minutes, so we are going to cycle out of this class. You're invited to the Investing Roundtable on May 25th of this month. We'll have 4 of our nights there, and it's a interactive, educational, entertaining hour or so to spend about investing. We do it in mid-Michigan once a month. Cy is one of the nights, Mark is one of the nights, Hugh McManus is a night, and I'm a night. And we'd love to have you come and sit around and discuss stocks with us. We're doing pretty well over our 11 years of existence, and we'd like to show you what some of our methods actually are. Again, thank you for coming this afternoon, and we hope we see you at our next class in just a few minutes. If you benefited from better investing, share the wealth. Tell somebody. Talk about our organization and help the organization stay confident and stay committed to educating the investors of today and tomorrow. Thank you, folks.